Okay, welcome everyone. Let's will start lesson 3. Today lesson will go through LO3, Learning Outcome 3, which is about be able to prepare the budget and the reports on the variance. So we'll go through the variance today lesson. Okay, before starting our lesson, please let's spend a few minutes. Just think about what we learned during our last two lessons, please, and then we'll start. Okay, guys, let's so we can let's please spend a few minutes. Let's will discuss what we learned during our previous lesson. Okay, so today lesson will go through LO3. In previous lessons so today lesson command will go through compare, identify as similarities and differences, explain, give the account and the purpose, analyze, separate information into component and access. So these are the key command verbs. So self-assessment, always scale 1 to 10, how much you know about working capital, budget, budgetary control, and variance. Variance is the difference between the budgeted and actual figure. That's called variance. So how much knowledge we have. So first we will go through identify, influence the forecast data produced by the business organization. So data is mean raw facts and raw information. Sources of data can be internal source, which is financial record, purchase invoices, wage information, and we have external source, government statistics, trade information, financial, and these are external. So we can look around the inflation, we can look around the new legislation, we can look around, and then we can per capita income, we can forecast for the future based on this. Okay, anybody, any question? So what is the variance? Variance is the difference between budgetary and the forecast data. We can forecast for the future based on various internal and external sources of information. Okay, so factor they are affecting. If the statistic plan is going to be have any chance to be being useful, it has based on the gathering and analyzing information. It's not possible to plan by sitting in a darkened room and dreaming up the scenario that have no connection to the reality. So we need to be real. Yes, so how we can be real? So we should have good information about political situation. We should have a good information what is happening in the economy. We should have a good information about social factor. We should have a good information about technology factor. So based on these, we can make the decision and we can forecast what is. So if the economic growth is 5%, which is highly likely, so industries will pick, and some will pick more, some will pick less. So that's why we need to be focused on forecast for the future. Okay. Next, when we look the forecast, it can be sale forecast technique. So method of forecasting forecast sales and the costs are required to be construct budget. The key budget factor or the limiting factor is often sales. Other budget involved. So sale forecast is the first thing. Then you can make the budget of material usage, material purchase, labor budget, cash flows. All we can make it based on the sale forecast. So marketing research and sampling we required in development new product. Time series analysis. Couple of you learn about correlation, regressions, trend analysis, moving averages. So these are all the statistic tools we can use for the future. The linear relationship between the demand of one product or the past pattern for the futures. We also look around the full product life cycle is growth, introductory growth, maturity, decline. These are all the product life cycle stages. Those we can use because at the different stage have a different. Okay, next we're looking the market research sampling. So market research can be used when launching a new product. So technique of sampling will be applied, and if not possible, the survey the entire population. Sample is selected, the result from the sample are used to be estimate the result of the whole population. So the sampling, random sampling can be, okay, welcome. Okay, so we can look around the random sampling technique, where we can, for the forecasting, we can use the randomly pick, the people. Like, yes, so quota sample, we can make the quota like 10%, 5% male, female, and basically on the basis of this, we can. Okay, so on the basis of this, so random sampling and quota sampling techniques, we can use these, techniques for making the forecasting. And then we have time series and analysis. So time series is a series of income and expense figures recorded in a number of periods. Time series analysis is a method of calculating the trend from the time series. And then the sale volume can be forecast by using the derive from the past sale volume and then apply the seasonal variation. So seasonal variation is a regular short-term pattern, increase or decrease the figure. We can repeat and we'll carry on forecasting for the future. So here are some examples. So we'll see here the forecasting using the trend and the seasonal variation. Y equal to T plus S. So D seasonalized adjustment value. T is a trend is equal to y is the forecast value, and equal to t is a forecast. Yes, we can look around plus s is a signal variation. So the forecast does not always require to use the techniques such as the time series analysis, regression, correlation. So that's we can. If t is a yes 560, s is a variation, is minus 45, and forecast is we expect 550. So suppose the y week 1 to 4 is 110, yes, 19, 110, and 5. So S for the week 1 to 7 is 10 minus 20 minus 10. You will see there 110, then it become 90. So you will see there the difference is a 20. And then you will see between 90 and 110 there is increase by 20, and then 110 to 150, so there is an increase as well with 4-week cycle. So calculate the T deseasonalized at the seasonalized adjustment data. So week 1 to T is equal to Y minus S. So week 1 is 110 minus 10. Yes, so we're starting with the 100 and is 110. Yes, so is equal to 100. Week 2 is 90. Yes, minus 20, 110. Week 3 120, and week 4 is 130. So increase or decrease T increase by 10 unit per week. So forecast the week 5 and 6. So 130 plus 10, that will be 140. It is a positive trend here. Yes, adjust by T, appropriate the seasonal variation. So we can look around the week 5. So Y is 100 and 140 plus 10 weekly. Yes, so we can say 150 minus 20 is 130. So that's the way we can forecast for future. We have some question here as well, proportion and multiple model we can use it, y equal to t plus s. So we just need to be simple this mathematical equation, we can use it to find the trend index and trend analysis moving abscess. So index is one other technique, which is retail price index, how many percent increase or decrease the inflation due to a number of reasons, that we have a price index. And then we can use this indexation and we can calculate cost of forecasting, and that's we can use this technique for the future. Okay, next we're looking 3.2, where we need to be prepared the organization budget from the given data. So we need a sale forecast. We can make sale budget, production budget, material usage budget. So first thing we need to be look around the sale forecast. Like, we've been given the sale forecast here in example, and then we can make all other budget. So when you make the budget, always keep in mind the reject, waste, and inefficiencies as well. So your budget not be under short. So like we can look around the general approach for the 2% gross production is rejected. So whatever you're producing, that's your 98%. So you need to be make it 100%. Yes. So the percentage, you need to divide the percentage, need to know you multiply it. Yes. So total production required 2940, 2% is the rejected. So 22940 times 100 divided by 98 becomes 2%. So we need to be make sure we'll make 3000 unit. Then we can be actual finished goods without any waste will be 2940. Huh? So the scrap will be 60 unit and the scrap value can be different. So when we making budget, we need to be look around all these, issues and that. So each unit takes, 4.5 kg of material. 10% material is evaporate. So if we are making 3000 unit, so we required material 4.5 kg times, yes. So usage budget of 1000 unit, if we are making 1000 unit of J, so times by, so we required 4500 unit, but 10% is evaporate. So 90% will get, the total. So what we need times by 100 divided by 90. So we required 5000 kg material will be used to produce 1000 unit. So if we labor hour 9000 required, yes, implies only available 90% of efficiency compared to the standard actual hours required the budget. So what we can is in 9000 required, but that's efficiency is 90%, so 10% is a waste time. So 99,000 times 100 divided by 90. So we can find it, how many labor hour, how much material, and all this we can use through. Okay. So incorporating into the sales, we can look around the sale, closing inventory plus opening. Opening always minus when we'll make the budget. So chain in inventory and then rejected faulty, and we can find how much we need to be produced. So overhead is mean the directly things not involved in the production. Those are overhead and overhead cost, like admin, like, IT costs, like marketing. They can maybe providing services to many departments. So those are called overhead costs. Okay, those always we need to keep in mind. Capital budget, which is about the non-current asset, which we buy, and integrity of budget is honesty is very important. So, any question, anyone? Next, we are preparing the budget. So, master budget mean overall budget for the whole country. Budget is called master budget. Then we have a departmental budget. We have operational budget. So we can make various budgets. So I quoted here example. We've been given the sales for cash budget. So we have these. We have a sales. We have purchase. We have a wages. We have salaries in these months. Then we've been given the criteria. The cash balance in October is a 15,000. 50% debtors, which is mean our supply debtors is mean our customer pay in the month when we sell. 50% paid end of 2 months. 50% we purchase one customer, they give 10% discount, so we have to pay 90% to them. New equipment we purchase and we need to make the budget here. So what we did, we make the budget here, and we have a templates as well which we can. So we are starting because we need to make 3 month budget, but it's a link with the previous 3 months as well. So payments, what we looking first, we looking here the template, we looking the sales. We sold it in July, 52,000 unit, 52,000 worth of the sale. 50% we receiving in July in the same month. 50% we receive in the following month. In August, 50% of August sales will receive in that 50%. So we'll carry on, but we'll only making the October, November. So we'll add the October, November figure. Then purchases, we are doing 25,000. Half of 25 is 12 and a half, but 12,500 we have to pay only 90%. So 12,500 times 90, because 10% will get discount. So we don't have to make the 10% that payment. Yes. So we can save. So we can do all this, and then all these figures we can transfer into. So in October, we've been given opening balance, how much receipt which we have in. So through you will see 46,500, and that's we included 46,500. So total we have incoming, and then we have purchases, how much we need to pay, wages, salary is a fix, every month. Then we have a sundry expense which is given, and then we have equipment. So we add them. So receipt minus payment equal to, yes, our closing balance, which is this. So 61,500 minus 41,475. So we have a positive. But in the November, we have a negative balance of cash. In October, in December, we have negative. In November, you will see that October will go last month closing, this month opening, so on. So we can make the budget in that way. Any question? So this is the cash budget, and that's the way we can forecast cash. And we need to make sure we'll plan, how much cash is required by the business, and we can forecast for the future, which is quite crucial, in a business to be sustained, because the cash is the lifeblood for any business. If any point you not get, please you can ask. Huh? Okay, next we're looking now. This is 3.4, calculate and analyze actual budget and the variance. So what is we've been given? If we prepare the budget profit forecast based on 90, 100, so we have 100 is 50,000 unit and 105. So 100 is 50,000 unit, and we've been given the unit price which we can sell it. Yes, in the next, so we've been given the price, so which I'll go through in a minute with you. So first, the unit 50 times 3, so that's 1,500,000. That's the value in pound. So 105. So 50,000 times 1.5. So that will be 105 times 3. So we are selling more. But if it's a 90, so that's the 90% of 50,000. Yes. So you can times by 0.9 times by 3. So we have a selling price. So that's the way we can. If is the actually we are selling 37,500 units, so you can say 37. So you can compare 37,500 units with the actual, because the activity should be the same for budgeted and actual, because otherwise we can't really do the proper or comparison. So that's which we can find the variance. Okay, so 37,500 times 3, so that should be 12,500. Yeah. So this is the actual activity. So what we'll do now, we'll compare with the actual activities of 37,500, or we can go through the budget. So here we can look around the revenue we've been given. Working one, actually the difference is variance. So how much is we have a difference in the revenue is 50,000. So if we'll go through the next step, here we've been given 37,500. Yes. So first we've been given 100%, which is 1,500,000 divided by 50,000, because 1,500,000 divided by 50,000. So we sold 30 pound each unit. Then you do 30 times 37,500. That give you 112,500. So the cost per unit. So we'll carry on then the cost of. So we've been given the cost of 50,000 unit as a material. If you look at the 50,000 material, 37,500 divided by 50,000. So you can find one unit and then you times by 37,500 units. So that's the way we can do all these calculations. So our flex budget should be 112.5, 100, but actually we revenue, so is the adverse variance of 50. If we sell £30 each unit, we should generate from 37,500 units this revenue, but actually we generate it, so we have adverse. So on, we'll do all these and we can find the variance is adverse and favorable. So all calculation and working is given on this slide. Any question? Okay, no, okay, that's fine. Next, please. So that's the way we can calculate and prepare the budget. So there are a lot of examples on Moodle, so please we can use them as well. Okay, next we're looking the budgetary control is very important, where we can look around, we can plan fixed and variable cost all and semi-variable cost, always we need to be look around. Okay, next we have 3.5, set the target. So types of the performance indicator, we can look around the quantitative, which is financial and non-financial, and qualitative, where we're looking more about. So we can look around obsolete figures, example of quality indicators such as rejected rates, efficiency indicator, unit produced per hour, idle time, capacity indicator involved in the machine utilization, how effectively we use the machine. Okay, then we have a quality always equal to the physical recording the rejected unit, qualitative measuring the customer satisfaction, like is the 90%, is it how many percent. So physical, non-financial indicators, number of the percentage of goods returned rejected, number of warranty claim, number of customer complaints. Financial indicator, cost per customer, unit cost return, cost of repairing, and all, and the customer survey, waiting response time. Yes, all these, we can look around if the service is good or bad, whatever we have, again the service standards. Wastage always we need to be considered. Is it example of quantity, weight, and volume? Bin waste, per shift, per machine. We can look around, and financial measure the cost of wasted, how much cost of scrap and obsolete item. So these, we need to be calculated to make the budget effectively, and we'll carry on reflecting, how effectively we have the budget and how effectively we are and how we performance, so as a manager. So efficiency, productivity, and capacity. Efficiency, productivity, and relevant to both labor and machine, and take refer to the labor hour, machine hour appropriate. So activity level depends upon how hard labor and machine work, the productivity and efficiency, how many labor hours, machine hours are available, and productivity and efficiency measures. This is basically the unit produced per employee or per machine. And capacity measures the number of machine hours which we can look around. Yes, what is the capacity we have, how much capacity we use, how much is the idle time, which is the idle time mean the time which was wasted and with not productive time. So that's, because we need to be make sure we make the time productive. That's, we need to be make sure. So that's, anybody any question? Okay, guys, then we have a 3.6. We need to be look around what is the budgetary control, is the use the comprehensive system of budgeting to add the management, carrying out the function like planning, coordination, and control. When we making budget, always we need to be look around according to the time, according to the function, according to the flexibility. We can look around the budget and we can prepare the budget. So I included a lot of example in my slide. So fixes mean the stay the same, and flexes mean the change compared to the previous year. So what we done here, budget can be fixed and variable. Yes, so flexing budget, which is based on the actual activity. Semi-variable cost is mean fixed and variable cost together. That's called semi-variable. Okay, so we included example here. Original budget was sale volume 120,000, but revised budget was 100,000, and actual result we have 125,000 unit or 140,000. So we can prepare and we can absorb the cost accordingly, whatever the actual budget we have. So you will see here all the working we have here, the sales revenue. So we can go here, like you will see here. So overhead absorption, always we have a labor hour, machine hour, and the unit of production. These three bases we can use to be absorb the cost that's been absorbed here. Under and over absorbed, it can mean under and overestimate, and that's which we can, all the working here we've been given the revenue we have, yes, which is based on which we done, like 37,500 units. The same example for merit we can use, and then this, if we want to be further merit criteria to be hit, we need to be look around the material, labor, and the expense, and all we need to be calculated separately. Cost behavior, we can this variable cost, the cost will change, fixed will stay the same. Semi-variable mean fixed and variable together, like a line rental phone is your call charges is variable, but the line rental is a fixed, so we call semi-variable cost, fixed and variable together. Step mean is the cost change. Like fixed cost never stay the same, it can be steps. So all been explained here. So fixed is straight line, step is can go up, like if we have a capacity, we can up to the capacity is a fixed, but if we have a more people, we need to hire the more room, we need a more space. Yes, so cost behaviors is a variable which is changed, semi-variable, fixed, and variable together. High-low method, we can use it when we have semi-variable cost to find how much is a fixed, how much variable. When we have a two level of production or two level of cost, we can write high number of units, and we have included example here. So if is activity 10,000 and when is a high activity, low activity is 2,000. So difference between units is the 8,000. We can look around the difference between cost 4,000 minus 1,600. So there is a 2,400. So 2,400 divided by 8,000. So it's 0.3 per unit. That's the variable cost. So how many units we have produced? 10,000 times 0.3. So that will be 3,000. So 4,000 minus 3,000. So 3,000 is a variable, 1,000 will be the fixed, totally the 4,000 cost. So 4,000 minus 1,000. So 1,000 is a fixed, 3,000 is a variable, and total is a 4,000. So that's the way we can find the fixed and variable cost. Okay. So any question? Okay, if we have a question, you can ask the cost behaviors and time. We can look around the period cost. We can look around the product cost. Product cost is related to the product for certain product, and period is related to the period. Then we can make types of the budget. All these being given the formulas which we can use to when we make the budget. So what I did, I included some example about the planning a budget of Davis groups. What you can do, you can copy and paste the link, and you can read the case study, please, before our next lesson. That's also help you to be develop further, the concept about the budgeting. So we can do quiz about the budgeting, please. You can copy this link and play with it, and that will help us to be clear our concept about the budget and budgetary control. So that's all was today lesson where we discuss about budget and budgetary control. Any question before we finish? Any question? All good. Okay, that's fine. Thank you. So if you have anybody, if those are listening this recording, please, if you have any question, drop me email anjum@ukversity.co.uk. And I hope so I'll speak to you during our next lesson, which will be about assignment discussion, which we'll go through. And thanks for listening and attending. Have a nice weekend. Thank you. Bye-bye.